we're going to start on Chapter 10. Chapter 9 was talking about long-lived assets and how we account for those assets. And we talked about salvage value and various methods of depreciation, and then reporting gains or losses on either the retirement of them, the sale or disposition of them. Okay? Any questions on Chapter 9 before we move on to 10? Are we just groovy on that one? Okay, so let's start talking about liabilities. A current liability is something, an obligation that the company expects to pay the debt from existing current assets or through the creation of other current liabilities. So it's an obligation that's current. So a current liability is going to be paid with either current assets or creating additional current debt. Company will pay the debt within 1 year or the operating cycle, whichever is longer. So if you had a question that said a current liability is debt that may be payable within 5 years. Is that true? No. Current. It's got to be paid within 1 year or the operating cycle.
The operating cycle is 5 years.
Then, if the operating cycle is 5 years, then in fact that would be a current liability. That's not that common though. Most of the businesses we're dealing with, the operating cycle is generally speaking within a year. Okay? There are scenarios like that, but I'm not going to trick you up on that. Current liabilities include notes payable, accounts payable, unearned revenues, and accrued liabilities such as taxes, salaries, wages, and interest that are all paid within the current operating cycle. To be classified as a current liability, a debt must be expected to be paid. Is it A, out of existing current assets, B, by creating other current liabilities, C, within 2 years, or D, both A and B? Yes. What's a note payable? It can be a promissory note. It usually requires the borrower to pay some form of interest for holding the note, for the individual to fund it, and it's usually those due within 1 year of the balance sheet date are classified as current liabilities. So when a note is made or a promissory note is created and the due date is within 1 year, then you're going to treat that as a current liability. First National Bank agrees to lend $100,000 on September 1st of 2014 if Cole Williams Company signs a $100,000 12% 4-month note maturing on January 1st. When the company issues an interest-bearing note, the amount of assets it receives generally equals the note's face value. So this note's face value is $100,000. That additional interest is going to be recorded as interest received or interest revenue. Okay, so they're going to end up receiving more than just the $100,000. They're going to receive the interest on the note, but initially, when they lend the money, Cole Williams will show on his books a cash for $100,000 and a notes payable for $100,000. Now, when Cole prepares their financial statements, it's going to report the interest that has accrued on this note, even though it hasn't been paid yet, because it's past. It's technically owed to the bank. So they're going to show an interest expense, interest payable, because it's not been paid yet, and then at maturity, Cole's going to pay the face value of the note plus interest. It's going to get rid of the note payable by debiting it. It's going to get rid of the payable by debiting it, and it's going to have an equal amount as a credit to cash. Do you guys have any questions on that? Do you guys understand now that liabilities have a normal credit balance, and when they're paid, it gets debited to zero it out? There's something called sales tax payable. This is generally in Minnesota, in most states, when sales tax is due, it's a percent. So depending on where you purchase an item, it's usually a 6.5%, and then various areas have added some extra pieces of their sales tax. If you're in, I think, Hennepin County, you have an extra SUR tax or SUR sales tax. So basically, the company that's selling the product is going to collect the tax. But that tax isn't the company's. That tax goes to the state. So they collect the tax, but they in turn have to pay that tax to the, in this case, the Minnesota Department of Revenue. So the March 25th register readings for Cooley Grocery Store shows sales of $10,000 and sales tax of $600. The journal entry is cash, $10,006, sales revenue of $10,000, and sales tax payable of $600. It's just a conduit to transfer those monies over to the state. Sometimes companies do not ring up sales taxes separately on the cash register. So if that's the case where the sales tax aren't segregated out, then what's going to happen here is Cooley rings up total receipts of $10,600 because the amount received from the sale is equal to the sales price plus 6%. So in this case, they're going to show cash of $10,600, sales revenue of $10,000, and sales tax payable of $600. So the way in which you can figure out the portion that was the sales, you just take that amount you received in cash and divide it by 1.06, because you collected 106% of the sale, okay? Unearned revenues. Revenues get received before the company really delivers the goods. In this case, when a company receives money up front but hasn't really earned it, then they're going to debit the cash and they're going to credit some form of liability. Unearned revenues, unearned rent, unearned something. Then when the company earns the revenue, it's going to get rid of that liability or debit it and then credit whatever that revenue count is. So the times this happens mainly relate to airlines. You purchase a ticket, okay? So when that ticket's purchased, it's been paid for and the money's been collected. But the company technically can't show that as revenue until that flight has happened, okay? Superior University sells 10,000 season football tickets at $50 each for its 5-game home schedule. The entry for the sales of season tickets is cash and unearned ticket revenue. As each game is completed, then Superior can show the unearned ticket revenue gets debited or kind of reduced, and then they get to show the ticket revenue. Because then the activity has occurred, the people have shown up, and we can technically record it as revenue because it's been realized, hasn't it? Now, there's another little trick to these current liabilities. Even though there might be a long-term liability out on the books, that current amount that is due in this year of that long-term liability is technically a current liability. Portion of long-term debt that comes due in the current year. What happens here? Here's an example. Windy Construction issues a 5-year interest-bearing $25,000 note on January 1st, 2011. This note specifies that each January 1st, starting January 1st of 2012, Windy needs to pay $5,000 on the note. When the company prepares financial statements as of December 31st, 2011, $5,000 is going to be shown as a current liability, and then $20,000 of it's going to be classified as a long-term liability. Because that $5,000 is due in the current period, it's going to be treated, that portion of it's going to be treated as a current liability. Same with payroll and payroll taxes payable. Salaries, wages in determining how payroll is recorded, we have to look at the gross earnings, the various payroll deductions, and net pay. So how many of you guys, you go and work for a company, they say, oh, we're going to pay you $15 an hour, and you go, yay, that means I've got, $600 to spend. Well, you get your check, and you go, wow, where's that $600? Because
Bureaus?
government what?
Oh, nothing.
No, what? What?
Oh, it's just the government jamming you up, taking your money.
It's depressing, isn't it?
It is.
It is very depressing. It is a sad thing. But guys, the reality is it costs a lot of money to run this government. Now, I am not trying to condone the waste. There's waste. You see this Lois Lerner, who's the head of the IRS, or a specific department in the IRS, and she's pleading the fifth in front of Congress regarding
That's effective, though.
well, they're trying to arrest her. I mean, they're trying to put charges against her right now
What did she do?
because they're trying to compel her to provide information for her actions, and she's pleading the fifth. Well, here she's working for a government entity. She's not willing to share what she's doing. So they basically want to try to find a way to force her to comply, testify, or else have some type of punishment associated with it. These are our government dollars at work. I mean, the waste is horrendous. So, I mean, I could go on and on about the waste, but it still is the best country we live in, isn't it? That's out there.
As far as we know.
As far as we know. It's true. As far as we know. As far as everyone else is telling us. But we do have freedoms. It costs money to have police. It costs money to have the firefighters. It costs money to have military. So the federal taxes we pay help fund all these things. That Social Security piece that you see getting taken out of your check is hopefully going to benefit you guys one day when you get to hit retirement age, and then you can draw on that also. So in dealing with payroll, we've got to learn a couple different items as it relates to various aspects of payroll expense. Cargo Corporation records its payroll for the week of March 7th as follows. Salary and wages expense of $100,000. Now that FICA tax, I was telling you that Social Security, that FICA tax payable is $76.50, 7.65%. The federal income taxes that came out of everybody's checks are $21,864. The state income tax payable is $29.22. So really, everyone's only going to get to see $67,000, or basically 67% of that total. So even it's roughly 33% gets taken out for federal, state, and Social Security. So this records the payment of payroll. So once the money is going to be paid, this payroll is actually paid out, we'll then debit our salaries and wages payable and credit our cash. Now the FICA taxes, half of them get taken out of the paycheck, your paycheck, and then the company also has to match the Social Security that is withheld from your paycheck. They have to pay an equal amount in to the government also. These are called payroll tax expenses that employers have to pay to the government. You're seeing what's getting taken out of your check. Well, the employer has to match that FICA they took out of your check. Plus, in addition, they need to pay federal unemployment and state unemployment taxes. How many of you guys have ever known of someone that is either laid off or somehow the company closes and they collect unemployment from the state? There's a fund out there that is set up for those people who do get laid off, and that's where every employer has to pay into that fund. So FICA taxes from the employer. Federal unemployment and state unemployment are these payroll taxes that the employer pays that you guys never will see. You know, the employee will never see. So Cargo Corp's $100,000 payroll, the company is going to record the employer's expense and liability for these taxes. So they're going to have a FICA tax payable of $76.50. They're going to have their state unemployment and their federal unemployment to total 13% or almost 14% of what they paid in payroll. They have to pay in addition various taxes. So here's the recording of the expense, and then once they pay it, all those payables will be debited and cash will be credited. Employer payroll taxes do not include federal unemployment taxes, state unemployment taxes, federal income taxes, or FICA taxes. Which one of those would not be part of employer payroll taxes? Federal income taxes, because federal income taxes come out of the employee's paychecks, right?
Yep.
Everything else in there, the employer pays. Okay. Let's look here. Now, bonds. Bonds are a long-term liability. They basically are a way of helping to fund the company. They issue bonds, collect some money, and basically borrow money in the form of a bond. They're a note payable that get issued by various entities, and they can be sold in denominations of $1,000 up to $10,000. When a corporation issues bonds, excuse me, not just $10,000, it can go up to $100,000. When a corporation issues those bonds, it's basically borrowing money. Think of a bond as borrowing money. Yes?
Don't like CEOs and stuff get bonds like for free? They just like give them to them?
No, they get stocks for free. And nothing's for free, they earn them.
Okay.
Not bonds. Bonds are basically something, there's two ways that corporations get money, receive money. One is from stock, equity shares, where they sell stock out, and people who buy that stock give the company money, and in return they have ownership in the company. And then another way that corporations receive money, they sell bonds. So when they sell bonds, they receive money, but those bonds aren't an ownership in the company. They're basically a liability. They're debt the company has to pay back.
So why even do that?
Because it can be a cheap form. Sometimes bonds are a cheaper manner of collecting money. Think of this, because you have to pay an interest on them, but then you get it back. They don't own a piece of the company. If Apple's doing really, really well,
So it's just like a loan then, huh?
it's a loan.
Okay.
But if Apple's doing really well, if you sell stock, they get a piece of how well they're doing. So a lot of times equity is more expensive. It's a more expensive form of financing than loans are, because you just have to pay back the 6% or whatever the interest rate is. But if you sell stock and the company had a return of 20%, well, each of those stockholders gets a return on the money, technically. Do you see what I'm saying? So generally speaking, when you guys get further down and you start dealing with equity financing and debt financing, sometimes you'll see that equity financing tends to be a lot more expensive. But a lot of times companies do that manner because they really want to expand significantly, and that's the only way they're really going to raise the money. Okay, so basically various types of bonds. There can be secured bonds, there can be unsecured bonds, convertible and callable. So secured bonds basically are a little more secure because they are attached to some type of asset in case of default. Unsecured bonds can be a little riskier because you're going to lend them money in good faith. Convertible bonds generally have an attachment where they can be converted into stock. So it starts out as a debt, but then you have the right to convert them into an equity form and receive stock in exchange for those bonds. And then callable bonds happen because, let's just say, in the current period, the interest rate on bonds is at 8%, okay? And these bonds are going to go over a 20-year period. Well, as in our case, all of a sudden the going interest rate is down at 2%. But companies are paying out bonds are at an interest rate of 8%. They want to be able to have the option to call those bonds in and reissue those bonds for a lower interest rate. So callable bonds have a stipulation that allows the company to pay them back earlier, so that way they aren't stuck paying a higher interest rate than what the market can bear. And then they can reissue those bonds for a lower rate. So know there are 4 types: secured, unsecured, convertible, and callable. What happens when bonds are issued? Basically, you'll see on the bond, the certificate, they're going to be given to the person who's lending the company money. So they're going to hold a bond, and it generally shows the name of the company, the face value, the maturity date, and the stated interest rate on that bond. So generally with bonds, you'll see something that says, here's a $1,000 bond due in December 31st, 2017 at a stated interest rate of 4%. Okay? That's how the bond certificate looks. The face value is generally what's due on when the money, what they're going to pay the investor. The maturity date's the final date when it is due. But the contractual interest rate, the rate to determine the cash interest paid, generally semi-annually, is going to be a portion of, and that's what we'll talk about. The contract interest rate is going to be that interest rate that's shown on the bond, okay? So let's just say the stated interest rate is at 8%. The contractual interest rate paid semi-annually would be 4% each 6 months, okay? Real simple right there. Here's an example of a bond. International Minerals and Chemical Corporation. The face value is $5,000. Do you see that? The stated interest rate on the bond is 11.875%. So here's your contractual interest rate. Your maturity date is May 1st, 2016. The company that issued the bond is International Minerals and Chemical. And the par value, or the face on the bond, the stated amount on the bond is $5,000. You guys see that? Be able to know what those specific items refer to. Now, those are all stated rates on the bond. But things with the market are going to go up and down. They're going to fluctuate. So we have to determine the market value of bonds. So that's going to be different than the stated rate on those bonds. The current market price of a bond is a function of 3 factors: the dollar amounts to be received, the length of time until the amounts are received, and the market rate of interest. So basically, the bond, or the certificate, shows the face amount, the stated interest rate, and the maturity rate. But we have to deal with various market conditions to determine really the market price, the market rate of interest, and if the prices paid below the face value of the bond, we call it discounting. If it's paid above that bond, it's a premium. So we're going to talk about that. Hang in there with me. This can be challenging, but we're just going to take it one step at a time. Assume that Acropolis Company on January 1st of 2014 issues $100,000 9% bonds. They're due in 5 years with interest payable annually at the year end. So not semi-annually, just annually at the year end. So what we show here is it's a 5-year period, okay? It's 9% bonds, which means technically $9,000, whoops. So $9,000 is due at the end of year 1. $9,000 is due at the end of year 2. $9,000 is due at the end of the year 3, 4, and 5. And then at the end of year 5, in addition to that $9,000, they owe back the principal, the whole $100,000. This is how the money actually is going to flow for purposes, simplistic purposes, with the bonds that Acropolis is receiving or has issued. This is how Acropolis is going to pay the money back. But what are people going to buy these bonds for? Are they going to buy it for $100,000? Are they going to give the company $100,000 up front and expect 9% on the bonds? That would be beautiful if they could. But in this day and age, do you know many companies that are going to issue bonds at 9% unless it's a really risky company? What's the going rate of bonds, you think?
2 to 4%, 1.5%.
Probably 2 to 4%, right? So would you buy, I mean, you'd love to buy a bond for $100,000 and get 9% rate of return. Chances are it's not going to happen. So we have to determine what's the market price of these bonds. So how we determine the market price of these bonds is we take the present value, today's value of what that $100,000 looks like 5 years out. So the present value of $100,000 received in 5 years, let's say today that's $64,993. And then we might take the present value of $9,000 received annually for the next 5 years. That's $35,000. So in this scenario, for this purpose, the market price of the bonds is $100,000. The present value of $100,000 down the road in 5 years, and then the present value of $9,000 received for the next 5 years. Okay, so one's a single payment annuity, chart. One is a series of payments, which we're going to talk about. So right in this case, the market value or the market price of the bonds is $100,000, but it usually doesn't work quite like that. Corporations will record bond transactions when it either issues the bonds initially or it retires the bonds. And when bondholders can convert bonds into common stock. Remember how we saw that some bonds can be convertible? So the bondholder may say, hey, instead of having this debt you owe me, I want to buy some stock from you. So it can be converted into stock. Bonds may be issued to these borrowers at face value, at that $100,000, or they could be issued below face value or above face value. So basically, bonds are quoted as a percent of what that face value is. Yes?
On that last slide, how do you figure out what the present value is?
There are charts in the book that we're going to look at.
So we don't have to know the math behind it?
No. You do not need to know the math behind it at all. Basically, there are present value and future value charts that will show based on a single annuity or a multiple payment annuity. And so you go and you figure what the interest rate is, how many years it's out there, and you go, you look and you bring the two together and you get a number.
Okay.
So you're not going to have to calculate that at all. Okay, you're not going to have to determine how you figure out those rates at all. The rate of interest investors demand for loaning funds to a corporation is the A, contractual interest rate, face value rate, market interest rate, or stated interest rate. Guys, the contractual rate or the stated rate are those items that are on the bond. But it's going to be the market rate is ultimately what people are going to expect to receive for their money. Okay? This is where bonds can be confusing because they have fixed on their paper certain rates, but based on what's happening in our economy, they're going to fluctuate. So we always do things based on the market rate of interest. Let's look at an example, guys. Devor Corporation issues 100 5-year 10% $1,000 bonds dated January 1st, 2014 at 100. It's issuing them at the total amount, the total face value. The entry to record this sale is cash of $100,000, 100 times $1,000 bonds, and a credit to bonds payable for $100,000. Now, what this means to me is that the market rate, the market interest rate is what's on this face value, the stated rate of 10%. That's all that means to me. Prepare the entry Devor would make to accrue interest on December 31st. So if on December 31st they need to accrue that interest, they're going to show a 10% interest rate at $100,000 for 12 months, or interest expense of $10,000, then interest payable of $10,000. Okay? That's simple, isn't it? Prepare the entry Devor would make to pay the interest on January 1st of 2015. So all we're going to do is debit our interest payable of $10,000 and credit our cash. They paid it. Does that make sense? Now, that's issued at par. That makes it pretty easy. What happens when bonds are issued at a discount or at a premium? So the contractual interest rate in this scenario is 10%. But when they're issued at the market rate, let's say the market rate right now is at 8%, then what is shown on the face is 10%. But the market rate is less than this. Bonds are going to sell at a premium, which means over the $100,000 figure. If the rate is at the stated rate is at the market rate, they're going to be issued at par or face value. And then if the market rate's higher than the stated rate, they're going to be issued at a discount. So this is important to see here. Bonds prices vary inversely with changes in the market interest rate. So you see here, the stated rate's 10, but the market rate's 8. So you would think, okay, if the stated rate's at 10%, yet our market rate's at 8, we're going to sell those bonds for greater than $1,000 each. Because if the interest rate's at 8, then instead of selling those for $100,000, we're going to sell them for a little greater because the market can't bear 10% interest rate. It only can bear an 8% interest rate. Think of it in this way too. If the market rate right now is at 12%, but these bonds are going for 10%, we're going to have to sell those bonds for less than $1,000 each because consumers are wanting 12% on their money, not just 10. So we might have to sell this for under the $1,000 so they can make 12% on their money. Hang in there with me. Okay. Carson issues 10-year bonds with a maturity value of $200,000. If the bonds are issued at a premium, this indicates that the contractual interest rate exceeds the market interest rate. The market interest rate exceeds the contractual rate. The contractual interest rate and the market rate are the same or no relationship. So do you see, if there's a 10-year bond with a maturity value of $200,000, bonds being issued at a premium means the stated interest rate on that bond is greater than what the market rate is. So as a result of that, we're going to sell those bonds for more than more than what the face value is. I think we need to take a break and let's look at some problems here, okay? How do you guys feel about that? Okay, so let's get in here. Okay. Boy, I was so close. Okay. Jenny Kane and Cindy Travis borrowed $15,000 on a 7%, $15,000 on a 7-month 8% note from Golden State Bank to open their business, KT's Coffee House. The money was borrowed on June 1st, 2014, and the note matures on January 1st, 2015. So they're borrowing this for 7 months. Okay? We need to prepare the journal entry to record the receipt of the funds from the loan. How do you think we're going to do this, guys? If we've got come on. If we have a, we're receiving $15,000, what are we going to show on June 1st?
Cash $15,000.
Cash $15,000. And what else, guys? A liability. What are we going to call that liability? Note payable. So we're going to have a cash of $15,000, and we're going to have a note payable of $15,000. And this is to record the loan received, taken out from X bank. Okay? That make sense? Okay. Next, we're going to go back and look. Prepare the entry to accrue the interest on June 30th. So what is it, how are we going to calculate the interest that is due June 30th? What is the interest rate? 8%. And if we took the loan out on June 1st and we need to record the interest for 1 month, how are we going to do that? We've borrowed $15,000 times 8% times 1/12. We've borrowed the money for 7 months, but interest rates are always stated annually, okay? So in this case, we're going to show an interest expense of $15,000 times 8% times 1/12, or what would that equal, guys? Can anyone help? Anybody?
$100.
Is it $100? And then what will be our credit?
Cash.
Not yet.
Add to the notes payable.
Interest payable. Of $100. Right? Okay. How many of you guys got that one? Do you see how important it is to know it's only 1 month out of 12 months, and that interest rate is stated in an annual period? Okay? Okay, let's move back on. Another reason, Martin, we know it wasn't cash. Do you see how it says prepare the entry to accrue?
Yeah.
If it said to pay, then it would be cash, okay? C, assuming adjusting entries are made at the end of each month, determine the balance in the interest payable account at December 31st of 2014. How much do you think we're going to show in the account as of 2014? What do you guys think? How are we going to calculate that?
7 months.
We're going to take 7 months out of 12 months. So 15,000 times 8% times 7/12 is going to equal what? So the interest accrued should be $700, right? As of the end of the period. Okay. Next, prepare the entry required on January 1st, 2015 when the loan is paid back. Let's think about that. What are some items we're gonna do here? We're gonna have to note payable of 15,000. What else will we have to debit to get rid of? Interest payable of how much? 800 or 700? And what's our cash gonna be? 15,700, right? Does that make sense? Any questions on that? Does that make sense, guys? Okay, let's take